So, welcome, listeners. I am Phil Brendel, and I cover distressed debt situations for Bloomberg Intelligence. I'm thrilled to have the opportunity to interview Dan Gropper at the Beard Group's inaugural Distressed Investing Media Night. Dan is the managing partner and chief investment officer of Carronade Capital. Carronade Management. Carronade Capital manages over $2 billion, focuses on distressed debt and special situations. Thanks for sitting down with us, Dan.
Thank you for having me.
So, quick synopsis of your background. You graduated from University of Virginia, then had extended stays at what I'd consider a who's who of hedge funds, Elliott, Fortress, and Aurelius, before striking out on your own in 2020 with Carronade Capital. Rather than stepping through your career like place by place, I'm hoping that you could share with us what you viewed as some of your pivotal moments, in your career, in your trajectory.
Sure. I would say the first pivotal moment was Elliott had probably its second down year in its history in 1998. And suffice to say, there was some involuntary turnover at the senior level. And at the ripe old age of 27, I had the opportunity to become a portfolio manager there and run a number of positions that were in the Elliott book. So I liken that to being thrown into a 25-foot deep pool without knowing how to swim because I had to figure it out very quickly. And so I grew up fast.
Yeah, I'd say. What would you say would be one of the big cases in your time there that really stands out as meaningful?
Yeah, certainly WorldCom. WorldCom obviously filed unexpectedly in 22. Elliott had a position in the MCI subsidiary bonds that became a very, very sizable position for the firm. I served on the official creditors committee of WorldCom and ran the ad hoc group there. And that was in the day before the 05 Code Amendment that, cut off exclusivity after 18 months. So cases typically in that era would last for 3 or 4 years. In that case, we managed to get from a filing to a consensual transaction with 9 creditor classes in 15 months, which was a pretty Herculean effort. I credit all the professionals all around and the other participants in that case, but that was a very formative moment, if you will.
That was remarkable. And just all that went on in that case was for it to get out that quickly. That's bankruptcies. Sometimes they could be really large and it's like a quick case. Sometimes they could be really small and just drag out forever. I think of Yellow Corp right now, and they shut down operations and it's still going on. So so let's jump into your investment philosophy and framework, because I'm going to zig a little bit, or I'm going to zag where people have zigged. They've been focusing on LMEs, I imagine, at the other panels, and I want to kind of jump into investment. What would you describe as your ideal investment?
Ideal investment for us as Carronade is one where if we're wrong, we get our money back, and if we're right, we make a decent rate of return. So really good risk-adjusted return and downside protection. They're not easy to find, but I think we've done a pretty good job of sussing them out over time, or at least come up with hedges that'll insulate us in the instance where we don't get it right.
Right. And I think that's that asymmetric risk reward that we all strive for. It's we can't lose money, but we can make maybe 10x when things go right. In terms of sourcing and finding paper, do you tend to have your ideas first and then go chase it, or do you canvass the market and get your ideas through some other means? Tell me how you get them.
I mean, it's really a combination of a whole number of different sources. I mean, we have a very senior trader who talks to all the desks kind of globally and in different sectors, whether it be high-grade investment grade, high yield, EM, converts, et cetera, to observe volatility, which is often, the first tell for us. Obviously, there's news flow that we monitor from, we all have Bloomberg terminals.
Yes.
And a bunch of other news services, and then the collective networks of the the Kieran partners across law firms and financial advisory firms. It's kind of a multi-pronged approach to sourcing. The toughest thing for us is to figure out which of those opportunities we're going to spend our time on, as opposed to finding things to look at.
So let's talk a little bit about security selection. I know you guys dig into the documents. That's a feature of a distressed hedge fund. It has to be. You know, how do you think about it in terms of diversifying? How many ideas you might have in the book, or if, in concentration, and then also when you come up with security selection, how do you hedge some of the risks involved?
So, in terms of security selection, again, we're looking for the best risk reward in the capital structure. Sometimes that's the senior secured debt, sometimes it's an unsecured bond, sometimes it's equity. It really just depends on the particular situation. The hedge is obviously fit for purpose, depending on what risk we're trying to hedge out. What we're typically looking to eliminate is commercial or business risk. And sometimes we can do that within a capital structure. Sometimes we'll do that with an instrument in a different capital structure to hedge out a particular industry-related risk.
In terms of liquidity, I know it's actually a function of scale of the hedge fund as well. When you get into a position, is it always kind of like you have a time horizon that you plan on holding it, or you just have something that you can get out of, if things turn around, go in a bad way quickly? I'm just kind of curious how you think about liquidity and scale.
So we're very cognizant of liquidity because we always want to put ourselves in a position where we can change our mind because there's new inputs. So we're very sensitive to how much of a particular bond we would own. We'd never own half a bond issue that puts you in a place where you can't trade out of it. Most of the capital structures we invest in are very large, very complex, and very liquid. So there's, frankly, a lot of liquidity, and we have the opportunity to change our mind should we want to do so. And in terms of a time horizon, somewhere between 2 weeks and 2 years. I mean, you never know going into a situation how long it's going to be, and we've been in some situations. We invested in the Twitter M&A situation in Delaware. That was very fast because you had a trial date and it was 4 or 5 months. And there have been other investments we've been in for 3 to 4 years. So it really just depends on what opportunities come to us. I think what we find is that once we understand a particular credit, oftentimes we'll see a number of opportunities in the life cycle of that credit that change over time. So we can start in a particular instrument and then 2 years later be involved in the same credit but invested in a very different security.
That's very interesting. So in terms of, we have a number of lawyers here tonight mingling around, having drinks. You and I both have abstained for now. I'm just kind of curious, in terms of advisors, I imagine you have a deep relationship with a lot of advisors and financial and lawyers. Does scale impact those kind of relationships, or do you, and also getting into groups and that sort of thing? I'm just curious some of the nuances there.
Well, we were fortunate in the early days of Kieran. I mean, we launched with just over $50 million, so we had really small positions. And we were very fortunate that the legal and financial advisors that I have relationships with protected us and got us into groups. Now, I'll say that was before the creditor-on-creditor violence wave when, you could help out a friend, and so that's easier. We're very fortunate now to be of a scale where we'll show up owning 50, 60, 70 million of a particular security, and so we're by definition relevant enough to to be in a co-op or in a group and gain admission. So I wouldn't want to be a small hedge fund today trying to navigate, the various creditor and creditor violence pitfalls.
And so, people, you've been at successful shops, you've been managed, and you're managing people now. You're managing a team, a firm. What do you look for in the people that you hire, and how do you like your team to interact?
So, top of the list is collaboration. There are a lot of people in the investment business that are really talented investors and are not good team players. And we have a very, very collaborative environment. Our investment process is collaborative, the portfolio management process is collaborative, the risk management process is collaborative. So, we need people that fit that personality. That's the hardest part of recruiting people into our firm, is to get people who not only can do the work but also like functioning as part of a collaborative team. I would say the other important characteristic is intellectual curiosity. It's not going home until you find the answer, and that's not saying that everyone you know spends their night sleeping in our office. They don't. But if someone pulls on the string, you want to make sure they keep pulling on the string until the sweater's gone. And I'm fortunate that we have partners and senior analysts at our firm that universally function that way.
That's great. I think we're going to turn to outlook, and we right now I'd say uncertainty plagues the market. The Trump administration's come in and turned the geopolitical order upside down. Tariffs, like, there was none of the talk of tariffs a year ago that we're having now, and then the Doge cuts in government. I think many at regulatory bodies are probably not even going to feel the repercussions of those for maybe months or years down the road. And just macro, this stretched consumer balance sheet, slipping consumer confidence, and volatility in the marketplace. That's a lot. How do you view the current environment?
I thought it was calm and there's no recession on the horizon. We're totally past it. Look, it's our firm view the economy was in a really bad place before Liberation Day. You had stretched consumers in terms of credit card delinquencies, auto loan delinquencies, federal mortgage delinquencies, student loan delinquencies, combined, and that I'll call soft data. And we also function in an economy where 10% of the population spends half the money. And if there's any impact on the spending patterns of that 10%, it's going to have a very significant impact on the economy. Well, that 10% just had their net worth kicked in the teeth. So, and we're already starting to see that. And I think you're observing, when we went through this earnings cycle of first quarter earnings that we're in the midst of, we saw that a lot of companies are either just not giving guidance because they don't know what's going to happen, or they're giving two versions of guidance. They're giving here's our guidance and here's our recession guidance, and we're not going to tell you which bucket we're in. So I think what we're in now is a period of heightened uncertainty. In my experience, businesses, boards of directors, management teams don't like uncertainty. They put off decisions in times of uncertainty. And if I were today sitting on the board of a major corporation, I'm not sure I'd build my new factory or start a new division or open, 14 new restaurants. Like you'd want to know what's going to happen with the economy. And so even the uncertainty without the second and third order effects that can and will occur from tariffs, even before that happens, I think you're already seeing people starting to pull back. And so it's our house view that the economy's in for a bit of a rough ride, which, if you're a credit investor, is a particularly good thing because it'll increase defaults and there'll be more restructurings, and that's where credit investors make most of our money. So ultimately, it'll be okay. But it's been pretty rocky getting there.
Right. In terms of U.S. fiscal. Oh, sorry, it just cut out there. The U.S. fiscals, that might be a problem. And the foreign ownership of treasuries, and just the general direction, the trend that we've been talking about in the markets has been sell America, where the dollar goes down at the same time bonds are going down and the stock market's going down. You know, is do you think that this time might be different, or do you feel like that's sort of a trend that will be too slow moving, that it won't necessarily impact as much the macro environment as kind of the slowing economy?
It's really tough to say. Look, I think in general, tariffs are bad for economies. They cause inflation, and they restrict economic activity. And so we could be in a position where, frankly, the Federal Reserve is totally boxed in because they have competing objectives of employment, inflation, and they just lock up and can't do anything. So I don't envy the Fed chairman right now.
Stagflation might be a real thing.
Stagflation might be a real serious thing, and what you're seeing with the dollar and other trade metrics is not good for the direction of the overall economy. And I'm not trying to get political here, but it's just basic economics.
Right. Any particular sectors that you find particularly frustrating or interesting?
We've spent a lot of time in TMT over the last, call it, 14 or so months. That's really been a result of our observation of the theme of convergence between wireless and fiber operators, which is here and real, and has, frankly, rescued a lot of companies, including Lumen, which was a restructuring we were a part of, from frankly the brink. And that's still playing out as a theme. Broadcasting is another area of exposure that we have, and hopefully ownership caps will change that will allow for M&A. That's been really long time coming in that industry. So those are a couple.
So I'm going to go back to the ZIG, and we're going to talk LMEs for a little bit. I came up with a little game. I'm going to give you some, quote, common sense thoughts that an investor might have about co-op agreements and liability management exercises. And so I'd like to get your score. Either you strongly agree, give me a 10, and if you disagree strongly, 0. So it is better to be in a cooperation agreement if one exists.
Yeah, 11.
Okay, we have a fan.
But only if Scott Greenberg drafted it.
I'm sure he'll appreciate that. If you aren't ready to put new money in a situation, you probably should be looking to exit.
It depends.
It depends.
It really depends on the situation. I don't think there's any easy answer. I think that sometimes new money is, used offensively as a weapon to prejudice people who don't want to put up new money. Sometimes companies actually need the money, and sometimes companies don't. So it's really situation specific.
So Dan, we talked about how you're not a lawyer, yet you've been involved in all kinds of litigations and that sort of thing. And you gave me the number one lawyer answer: it depends. So you truly have learned all that you need to know about the law.
Well, I'm sure there's more I can learn.
So here's number 3. I'd rather have high participation in an LME I'm participating in than a fee-loaded 51% simple majority winner-takes-all deal.
Clearly, option 2 is better, but only if your friends are in it as well.
There you go. And then my last one: LMEs are for improving rank in a capital structure, while Chapter 11 is for deleveraging and taking back equity.
I'm gonna give you my lawyer answer on that one again, because I think it does depend. I think it does depend. I think you could use effectively an LME to take equity. There's no prohibition on that.
We just don't see it much.
You don't see it much. But I think it'll be interesting to see the outcome of all the LMEs that took place, and someone should go back and track like how many of them actually worked, as opposed to just doing the filing thing from the get-go. Although, it appears very few companies file for bankruptcy anymore these days.
Yeah, no, they really truly avoid it. So here I'm going to give you a last one. The distress space is wild with turns. I suspect few ever anticipate. Like, for instance, FTX creditors got paid in full. Hertz shares traded like up more than 10 times coming out of bankruptcy than they were going in. And I'm just wondering if you have any particular experience, or be it a scar or a windfall, that just was like completely unexpected, that in your investment career that you would mind sharing.
Honestly, it was the restructuring of Talent Energy that we were involved in, and I would say that the piece about it that was unexpected. There's this old bankruptcy joke of what happens if you find 25 million of gold bars in the basement of the corporate headquarters, and I feel that that's what happened in Talon, because when Talon was running out of money before it filed in 2021, the then CEO took money out of the restricted group of the banks and built a 300,000 square foot data center in the middle of rural Pennsylvania without a tenant. I think it's the only time a data center has been built without a tenant in the history of ever. And when ultimately Talon came out of bankruptcy, in 2023, I remember people saying, well, gee, gosh, if we can only get back the $250 million that they have into this data center, it'll be a great day. And then AI became a thing, and we realized that having a 300,000 square foot data center across from a power source, which was one of one. There's no other data center literally, 200 yards from a power source, sitting there. And so I don't think we certainly didn't expect it. We welcomed it and profited from it. So I'm certainly glad it happened. But it, obviously Talon went on to be one of the, most successful restructurings, in the history of ever. So that was.
I remember that equity check the unsecured note holders wrote. It was large.
That it was.
Dan, this has been great. On behalf of our listeners and myself, thank you for joining us at Media Night and sharing your insights with us. Thank you.
Thanks for having me.